Have you ever found yourself wanting to invest in real estate, but couldn't afford to purchase any property? If so, then you're not alone. Many people dream of getting into the lucrative world of real estate investing, but are worried about the cash necessary to get started. Luckily, there are several different ways you can get your feet wet without spending much, or any, money upfront. Number 1. Wholesaling. You can invest in real estate with no money by wholesaling. This involves getting into a potential deal before it's officially on the market, oftentimes before the seller even knows they have buyers interested. You need to come up with a fair offer and present it to them, then take care of all the paperwork and arrange for payment when the property sells. You'll usually make your profit on the difference between what you pay for the house and what you sell it for. The downside is that there are some things that are out of your control, like if the home doesn't appraise for as much as you hoped. Number 2. Home equity. Get a home equity loan or line of credit. If your house is worth at least $500,000 and has been your primary residence for the last 2 years, then chances are that there's an easy way for you to borrow up to 95% of its value via a home equity loan or line of credit. For example, if your home is worth $600,000, you could borrow up to $540,000 from the bank. To take advantage of this type of financing, all you need is decent credit scores and enough equity in your home so that you can still afford it even after borrowing money from a bank. You might want to talk this over with a real estate agent before getting into this kind of loan. Keep in mind though, interest rates on these loans are typically higher than other types. Number 3. House hacking. House hacking, or buying a home and renting it out for extra income, is a great way for someone who does not have any money available for investing to get started, but it's important that you do your research before diving into this type of investment. A good way to find out more about house hacking is by looking into the different websites, books and blogs that cover this subject. Some of the most popular resources are Forbes magazine, The Wall Street Journal, Huffington Post and Bigger Pockets. They all provide detailed instructions on how to get started without much cash flow up front. To be successful at house hacking requires some hard work and self-control on top of using common sense and being aware of what potential pitfalls might arise during the process. You will need time to fix up the house, make repairs as needed, advertise properly for tenants, renters, deal with contracts that come up when renting out rooms, and pay attention to what is happening in the housing market so you know when there are prices increases or decreases in certain areas, which will affect rent prices too. Number 4. Government loans. The government provides subsidized loans for low-income families and first-time home buyers. Low-income families may qualify for a FHA loan, which has an interest rate as low as 1%. First-time home buyers may qualify for a USDA loan, which has an interest rate as low as 2%. These rates are much lower than the market rate, which can range from 3% to 5%. These are just two of the many programs offered by the government for investing in real estate without any money. You may also be eligible for grants and other financing options depending on your income, employment status, and other factors. Talk to a financial advisor or mortgage broker about how you might be able to afford investing in real estate with no money. This is how FHA loan works. It's often called the FHA guarantee. It allows you to borrow up to 97.5% of the purchase price, or appraised value, of the property you're buying. There's no down payment required for most applicants. In addition, it offers competitive interest rates and requires monthly mortgage insurance premiums that are typically less than those charged on a conventional loan. They do require an upfront charge at closing, called mortgage insurance, which covers up to $10,000 worth of losses if you default on your payments. First-time home buyers. If your household earns less than 80% of median family income in their area, then they may be eligible for a USDA loan program. This is how USDA loan works. It's often called the Rural Development Guarantee. It allows you to borrow up to 100% of the purchase price, or appraised value, of the property you're buying, but there's a catch. There is no down payment required for most applicants, but you must live on the property for at least 1 year or else you'll have to pay back the loan and all of its interest and charges up front. You will not have to pay back any of these fees if you stay on the property long enough to meet this requirement. Number 5. Investing in REITs. REITs stands for Real Estate Investment Trusts. They are traded on the stock exchange, like any other publicly traded company. The difference is that they invest in real estate and derive their income from rents and mortgages. You can invest in these companies with no money by buying shares of their stock through a brokerage account. As such, if you buy shares of this company's stock at $100 per share, you will have invested $10,000 without spending a dime. REITs are an excellent opportunity for generating passive income because your dividends come directly from the buildings and land owned by the REITs. If you were to rent out your property as an investment property, then you would be constantly working to maintain it and make sure it was rented out. That means 24/7 work just for one property. But with a REIT, when it needs maintenance or repairs, the parent company, the REIT, pays for them, freeing up your time and enabling you to focus on other things. And because of how REITs work, there are never any huge tax bills coming due, so again your time is freed up for more important endeavors than trying to figure out where taxes went wrong. Number 6. Microloans. As the peer-to-peer economy continues to shape how real estate investors do business, microloans have become an increasingly popular option for those looking to invest in real estate. Microloans can be a less expensive, more personal and more flexible way of financing your next investment property. With these loans, you borrow as little as $1,000 from an individual or small group of investors and you pay back over a period of months or years. That's much different than borrowing from a bank, where you would need to put up collateral and get approved for the full loan amount before moving forward. In other words, if a bank will only lend me $100,000, I could put up my house worth $500,000 as collateral, but that would make my whole life savings on the line for one investment, which is really risky. Number 6. Seller financing. Unlike traditional loans, seller financing works like this: the buyer and seller agree on an agreed-upon price for the home. Then, instead of paying all of the money up front as is done with a typical loan from a bank, the buyer makes an offer that includes both a down payment and monthly payments until the full amount has been paid off. In order to make sure that they don't get taken advantage of by someone who doesn't plan on making their monthly payments, sellers usually require some sort of collateral before signing off on such an agreement. The collateral can be anything from personal property like a car or boat, to land deeds or other assets that are valuable. Number 7. Equity partnerships. A very common path in real estate investment is through partnerships. In an equity partnership, you typically take on a small amount of the risk and share the profits. For example, if you put down $2,000 and partner with someone who puts down $10,000, you each invest 50% of the money for a total of $12,000. Your partner will handle things like finding tenants and taking care of the properties. If one property ends up making $3,000 per month and your partner takes care of all the expenses, e.g., property taxes, then that would mean that they receive half, $1,000, while you get 25%, $500. Of course, these percentages are just a general guideline. You may want to negotiate them based on your experience level or what percentage you have invested in the total cost. Number 8. Hard money. With a hard money loan, you get all the money up front and pay back the loan over an agreed-upon period of time. There are two main types of loans: a construction loan and a bridge loan. A construction loan is where you borrow money up front to build a property for sale, so you won't have any equity when it comes time for selling it. A bridge loan is where you use the funds from the lender up front for your purchase and then repay it later on with interest as agreed upon. The key here is that there will be some equity involved when you sell this property. Please like and subscribe to Capital Investments for more investment videos.